So Bitcoin is also driven by global liquidity, but it's also the adoption of this new technology, which puts it in this stupid exponential secular trend, but with volatility. The volatility, the big volatile drawdowns are just driven by liquidity. So this year, we've already established is a liquidity positive year. In fact, a very big liquidity positive year because you need to roll all of this debt. So generally speaking, it should be a very good year for cryptocurrencies. However, we're in this period where the Federal Reserve and the Treasury, and because of the dollar, have tightened liquidity over the last couple of months. It's forward looking, so it's affecting cryptocurrencies right now. So they've been soggy for a while because liquidity was tightened a while ago. But again, our expectation is it shouldn't last that long in price or time. And then we've got liquidity all the way through this cycle. Now, if we go back to 2021, the prior post-election cycle, because the pandemic had seen the global economy go down to zero, then go straight back up again, the business cycle peaked really early in April 2021. Normally in these presidential election cycle years, the business cycle peaks towards the end of the year. So Bitcoin had a very complicated 2021, but what we're doing now looks very similar to the 2017 post-election for Trump. And what we saw then was ongoing injections of liquidity. We started the year with a sharp 30% correction or 25% correction, the sort of thing we're getting now. And then liquidity just came all year. And it wasn't actually massively put in by the US. It was actually China last time. And I think we might see that again this time, where China is going to play an important role in global liquidity. So I think it's going to be a much stronger year than people expect. People have a lot of PTSD from 2021, where it peaked early, then collapsed, then went back up again, then collapsed. I think it's going to look more like we saw in 2013, 2017. So yes, I remain very bullish for this year on all risk assets.
Raoul Pal speaks with a tone of urgency towards current Bitcoin holders and people that are on the fence so that they can pay attention and either get in or buy more before it is too late. Wall Street powerhouses and seasoned money managers are gearing up for action, driven by excitement over the potential national endorsement of Bitcoin as a mainstream financial asset. Welcome back to Investocracy Crypto.
So if I use similar numbers, let's just use round numbers. It's at 100,000. You see it pulling back 25% to 75, and then take off.
Probably
again.
not even. I don't think it goes down 25% because there's ETFs and there's the market is more mature. So let's say let's say 90,000. So it goes from 100 and where did it get to? 110 down to 90,000. Okay, that seems about right. So not far from where we are now. And then it finishes the year in a worst case scenario. I think it's like 200, 250. In a base case scenario, it's kind of 350. And in a blow off top cycle like 2017, back end of the year, could go north of 500,000. It's difficult to know. So I always kind of give a probabilistic tree of, these are the kinds of zones.
Do you have any views on gold?
Look, gold is driven by the same thing, which is debasement of currency. It just doesn't have a tech adoption curve, so it doesn't go up as much. So gold will, considering, again, we're in the liquidity cycle where you have to debase currency to pay your debts, gold should continue to do well. I'm bullish gold. And I think that'll continue to do well for the rest of this market, particularly when the dollar starts falling as well. That's good for gold. So overall, I think it's a very good market for gold, very good market for most risk assets.
So you often say in a lot of your online interviews that we have 5 years to make a lot of money. And I think you touched on this a little bit earlier when you were talking about AI and robotics, et cetera. But maybe you can provide some more context. What exactly do you mean by that?
So my job as a macro investor and analyst is to look ahead in the future and try and figure out where the world is going. I have been using a framework since 2000 and since 2000 of debt deflation and demographics. And that framework has been in play ever since. It got me the right side of the financial crisis. It got me the right side of the European crisis. It got, you kind of could see the world through that lens, and it worked very well. I missed the rise of technology earlier on. When I look forwards, the whole world that we understand it is driven by scarcity. And generally, as we've transitioned from manufacturing economies to service economies, scarcity of knowledge is the thing. That's why lawyers get paid so much money, and accountants and financial advisors and doctors and surgeons and all of this stuff, radiologists, is because there's a short number of people, large demand for the services. AI has just made that knowledge a zero.
Driven by the president's vision, efforts are underway to weave Bitcoin into the fabric of America's financial infrastructure, with institutions eagerly contemplating the vast potential that lies within reach. The excitement among Bitcoin believers is almost palpable, yet not without its share of skepticism. As Elliott, a prominent hedge fund, cryptically warns of an impending catastrophe, echoing sentiments of doubt and predicting havoc in ways we cannot yet anticipate. Enthusiasts remain unfazed, however.
Our GMI Bitcoin cycle top finder is just still nowhere near signaling a peak in Bitcoin prices, and nor do some of our other indicators. So here's, core risk indicator, which is basically just a series of oscillators grouped together and ranked in the Z-score. Again, I always make fun of this name. Who names these things? Me. Our Bitcoin valuation model, again, here, it's just a percentile model with a bunch of factors. And from a quantitative perspective, it's not the cross above the 90th percentile that forces you risk off, right? It's actually the cross above the 90th and then something like a cross below the 85th percentile. And that will then flash red, but just not there. And then returning to this analog, I still believe it makes a lot of contextual sense for this year. Expect frequent pullbacks, some of which could even last a couple of months if you look at the 2017 cycle, because this is the 2017 cycle, just shifted by a couple of weeks. But this is the roadmap that I think, Raoul and I have in our heads for this year. Choppy at times, yet ultimately a slow grind higher. And this doesn't only apply to Bitcoin, it applies to risk assets more broadly. And so here's the 2017 cycle, so a reminder of what we did back then, which mirrors exactly what I just described. Choppy at times, but ultimately it was a slow grind higher. So very much, as I say, the pattern we're anticipating this time around. And then there's this chart. I like to bring this back now and again because everyone's tweeting about valuations. And historically, as I said before, valuations within a quantitative framework have only flashed red 5 times since 1980. So they've only been a problem 5 times historically, looking back to 1980. And so as the ISM moves higher, earnings we know will begin to improve. And this will justify the 2023-2024 valuation premium.
As Wall Street titans cautiously warm up to the digital giant, the sentiment is changing. Matt Hoogan from Bitwise elaborates how Trump's administration has effectively removed existential threats that once undercut Bitcoin's credibility. Investors, once nervously sitting on the sidelines, are starting to jump in with both feet, their concerns allayed by a clear-cut regulatory environment. But before going any further, if you made it this far into the video, thank you. These videos take a lot of effort and time to make, so if you enjoyed them, please hit the like button and subscribe to the channel. This goes a long way in helping us grow. That said, back to the video.
Together, okay? Well, a lot of people have talked about this, right? So you have spring, summer, fall, winter, so the crypto seasons. Now, in 2013 and 2017, we had a big run, right? But then if you look at 2021, this was the cycle that, which caught a lot of people off guard, because a lot of people were thinking that we're going to have a redux of the 2013, 2017 cycle. Instead, it ended up being this truncated cycle. So in Q4 of 2020, I remember being in Geneva and giving a presentation, which I talked about this, giving a presentation at the Four Seasons Hotel titled Dancing on a Volcano. So the time I was still managing money, but I could see lead indicators were rolling over. I'm going to show you this in a second. And because it was my job to take risk, as an investment manager, I had to still dance, but I knew something was coming. And as I say, I'll show you this in a minute. And really what happened is that because of COVID, the base effect, you have to remember that the ISM is a diffusion index, but it behaves like a year-on-year comp. So the fact that the ISM fell to 41.8 like that means that from a year-on-year comp perspective, all the comps, when you look at all of them, and then it went to 63.8 like this, it just shot back, which meant that the ISM accelerated from 41.8 to 63.8 in basically record time.
The current landscape sees Bitcoin trading near historical highs, an electrifying testament to its enduring appeal. Experts like Larry Fink at BlackRock suggest that with broadened sovereign investments, Bitcoin could skyrocket to $700,000, a number that sends tremors of excitement through the market. So, what's your take? Share your thoughts. And finally, if you would like to know more about cryptocurrencies, or specifically Bitcoin, go ahead and click on the next video on your screen. See you there.